Thanks so much for coming along to our next edition of Econ Talks. Gareth, this week, monetary policy back in the frame, one of the only things really that we've had to talk about after GDP. There's not a lot that comes out immediately. What is the Reserve Bank's position moving forward from here?
Yeah, a little bit of a surprise this week in terms of the signals they were putting out there. Basically, the Reserve Bank communicating that they're looking to put in place a funding for lending program before the end of the year. That's effectively where they lend to the retail banks at an interest rate which is maybe a little bit above where the official cash rate is. The aim there for the Reserve Bank is to bring down the funding costs for banks. And enable them to therefore lend out money at rates that are even cheaper than what we're seeing now. So just again, looking to bring down those retail rates to try and make it cheaper for both businesses and households to borrow than what we've seen at the moment.
And I guess one of the big changes this week with the announcement was the possible speed that this funding for lending program might come in. And of course, it's been talked about as one of the Reserve Bank's four broad options for new monetary policy moving ahead, alongside, negative OCRs and such. And I guess what was interesting is the Reserve Bank saying, actually, we might do this alone now. We're going to have to hold our forward guidance through until, March next year, when they said they'd keep the official cash rate, the OCR, on hold. But saying, actually, we realise that there is a bit more monetary stimulus that might need to come in, and therefore we might try and bring this in, sounds like before the end of the year, which is quite a change when it was previously thought at the same time.
Yeah, so the Reserve Bank a little bit hamstrung in terms of the official cash rate at the moment, given the forward guidance they've got in place. So, with the view that obviously the global economy is still causing a lot of concern with COVID getting worse rather than better in the likes of Europe and parts of the Americas as well. They're concerned about what that means for New Zealand's economic outlook. And indeed, when we look at activity, while activity levels within New Zealand have been pretty solid, there is a lot of concern about what the next 6 to 9 months might hold, and the Reserve Bank looking to get in ahead of that and stimulate the economy further. So yeah, you're right. Quite a change there in terms of their approach to or the timing of when they're likely to come through with anything.
And I guess it was also interesting, you've got that in terms of the direction of where monetary policy might go. We've also seen in the last few weeks the Reserve Bank has been upping its purchases after it expanded the LSAP, the large-scale asset purchase program, up to 100 billion. I think now they're spending $1.4 billion each week now to buy up different bits and pieces across the market. A lot of them are government bonds, of course. Now, that, I think one of our economists did some calculations around about a 44% increase. So the interesting thing there moving ahead is that you've got both the LSAP and the OCR, which will make changes. The likes of funding for lending, though, might mean that we don't have deposit rates for term deposits fall quite as steeply, although those borrowing rates are still going to go lower, aren't they?
Yeah, that's right. I think right across the board. But one of the keys there is the Reserve Bank trying to shift the where the banks get their money from and put less pressure on those term deposits. I mean, there's not a lot of incentive to keep your money in the bank at the moment anyway, with those rates sitting in the low ones or indeed under 1%. So already probably some stresses there for the banks, and so Reserve Bank really looking to step up there and provide a bit more surety in terms of the funding that's available for the banks. I mean, the other interesting issue, of course, is if you drive those interest rates down, the borrowing rates down at the moment, there's not a lot of appetite amongst businesses to go and borrow, and just because you cut the interest rate further is not really necessarily going to change that. The difficulty, of course, the Reserve Bank is facing at the moment is all it's doing is seeming to fire up the housing market. And one of the interesting things I've picked up over the last week is that, one of the areas they don't have to monitor anymore in terms of the agreement with the government is asset prices. If you go back a few years, that was brought into the policy targets agreement, but it's no longer in there. And so Reserve Bank seemingly content to, look, inflating the housing market isn't ideal, and I think they recognise that, but there are some potential positive spin-offs it has in terms of, the wealth effect and making people more comfortable about spending. Certainly, I guess, more palatable for the bank than having the housing market crashing at the same time when you've already got the economy under pressure. But obviously, in terms of some of the equity issues, particularly for people who aren't in property, creating some more problems there.
But at the same time, I guess, like you've highlighted, the Reserve Bank doesn't have to, pay too much mind to it, and possibly shouldn't. It sets interest rates indirectly via some of the channels it has. It can't, and in fact, probably shouldn't try and dictate too much where that money goes. When we saw the last time that the Reserve Bank tried to put a lot of conditions on lending with some of the small business schemes, the pickup was virtually nothing because it was too hard. There were too many hoops to jump through. It was just far too difficult. And so I guess that brings a question back to, well, who actually should do it? And it's very much if you have a monetary policy, which is a blunt instrument, you allow it to set conditions. It sort of comes down to both fiscal policy, but also fiscal and government regulation as to how that money is utilised. Capital is capital. It's where that capital is eventually invested, which the Reserve Bank just doesn't really have that many levers, I guess, to pull at the moment. But look, I mean, where do interest rates go from here in terms of mortgage borrowing? Certainly, that 2% looks very much on the cards at some point in the next year or so, doesn't it?
Yeah, I would think so. I mean, you've got 1-year mortgage rates rather sitting at under 2.5% now. It's quite easy to envisage those dropping below 2% once this funding for lending program and indeed any future OCR cuts come through in the early part of next year. So yeah, only going to get easier for borrowers in terms of servicing the mortgage.
So still, look, a lot of heat there and a lot of water to go under the bridge also before not only we get this funding for lending, but also that potential for the negative OCR and similar next year. And this monetary policy, although it is indirect, still has some pretty major consequences. So we'll continue to monitor that one. Look, Gareth, always great to chat. Fantastic. Have a good weekend, and we'll catch you and everyone else on the next edition of Econ Talks.